Today, we're going to do something a little bit different. We're going to pull back the curtain and get inside the mind of a professional trader by breaking down their actual end of day report. This isn't just about the numbers you see on the screen, it's about the strategy, the psychology, and the raw discipline behind every single decision. And that really gets to the heart of it, right? How do you take a single page of data from one chaotic day in the market, all the wins, the losses, the close calls, and actually turn that into a concrete, actionable plan for the next day? Well, that's exactly what we're going to figure out. So what we've got here is the real deal, a genuine trading scorecard from March 24th, 2026. This isn't some textbook example. These are the trader's own notes, their raw analysis of what worked, what totally bombed, and most importantly, why. It's a completely unfiltered look at making high-stakes decisions under some serious pressure. Okay, so here's the top-line summary of the day, and you can see right away it was a real mixed bag. You've got a massive win with ExxonMobil hitting a new all-time high, plus a market hedge that was doing its job. But then, on the other side, two pretty big trades in Palantir and Micron got stopped out for a loss. It's this messy mix of good and bad that makes the analysis so incredibly valuable. All right, first things first, let's dive into the day's biggest success story. And it all centers on a really powerful bet on the energy sector. The absolute star of the show was ExxonMobil, ticker XOM. It surged over 2.5% to a brand new all-time high. Now, on a day when the broader market was actually down a bit, again like this is just a massive outperformance. But here's the thing, this wasn't just a lucky guess. It was the direct result of a very specific strategic bet. And that bet is what the trader calls the energy thesis. The core idea here is pretty straightforward. The belief is that all the geopolitical conflict heating up in the Gulf isn't just a temporary news headline. It's creating a structural, long-term shift that will push the price of oil higher. And of course, that makes companies that pump oil out of the ground, like Exxon, fundamentally more valuable. Now, what's really fascinating is how the trader played this idea. Instead of just buying the stock outright, they used options to get more leverage. Look at this. One of the contracts was already deep in the money, which basically means the stock had risen so far past the options price that it was sitting on a pile of pure profit, just ready to be cashed in. Another one was getting super close to being profitable too. It's a really smart way to manage your risk while aiming for bigger gains. And you can just see the confidence in the trader's own note to themselves. It's crystal clear. The thesis was on the money, the decision to add more to the position was the right call, and the results proved the whole strategy right. The big lesson here? Having real conviction in a major trend can really, really pay off. Of course, not every trade is about betting on something to go up. Sometimes the smartest move you can make is to bet on things going down. It's a strategy known as hedging, and it's basically playing defense. The main tool for this defensive play was something called a put option on the SPY, which is an ETF that basically mirrors the entire S&P 500 market. The simplest way to think about buying a put is that it's like buying insurance on the market. You're making a bet that prices will fall, and if they do, your put option goes up in value, helping to cancel out losses you might have elsewhere. And during the main trading session, the market did exactly what was expected. It fell. So the puts were working perfectly, gaining value. But here's the catch. Look what happened after the market closed for the day. The SPY did a complete 180 and rallied in after-hours trading. And just like that, the profits from that hedge started to evaporate. And that leads to such a critical lesson that the trader jotted down. Holding these short-term hedges overnight is a risky game. The market doesn't just go to sleep when the closing bell rings, and a big recovery overnight can turn what looked like a brilliant hedge into a losing trade by the next morning. Okay, now we get to what might be the most important part of this whole breakdown, the losses. Because for a real pro, a losing trade isn't a failure. It's just data. It's a golden opportunity to fine-tune the rules and build a smarter strategy for next time. So first up is Palantir, ticker PLTR. The stock took a sharp dive and hit the trader's preset exit point, their stop loss. But instead of just writing it off as a loss, the trader spotted a repeating pattern. They noticed the stock tends to spike on good news, pull back hard enough to shake people out, but then buyers step in to defend a key price level. This lets the stock rebase before it makes its next move higher. And this is just a masterclass in discipline. The stop-loss rule did exactly what it was supposed to do. It got the trader out of the trade and protected their capital from a bigger loss. But because they see that underlying pattern, they know the core reason for owning the stock, the thesis, is still good. So the new plan is simple. Wait for things to calm down and then get back in. The other loss, well, this one was a lot more painful. This chart shows the absolutely brutal sell-off in Micron Technology, or MU. The stock had just plummeted over 14% in only 6 days of trading. This wasn't some gentle pullback. This was a total collapse in momentum, and the trader's position got run over. And the self-assessment here is just brutally honest. It wasn't bad luck. The analysis is that the entire structure of the trade was just wrong from the start. Wrong vehicle means the specific option they chose was a bad fit. Wrong DTE, that stands for days to expiration, means there just wasn't enough time on the clock for the trade to work out. And, well, wrong timing speaks for itself. But this is where a painful loss becomes an incredibly powerful tool. The trader doesn't just lick their wounds and move on, they create a brand new concrete rule for the future. From now on, when buying a dip like this, they must use options with at least 45 days left, and they have to pick a strike price that's super close to the current stock price. The losing Micron trade broke both of these new rules, and now it serves as a permanent, expensive reminder. So finally, let's see how all of this, the big win, the tricky hedge, and all the lessons from those tough losses, get synthesized into a clear, actionable plan for the very next day. And this is the final product, a prioritized checklist for the moment the market opens. Look at the labels: critical, high, medium. The number one most critical action is to dump that losing Micron trade right at the open. No second guessing. The high priority items are all about managing the winners, taking some profits off the table in Exxon and keeping a close eye on Palantir for that disciplined re-entry point. Everything is laid out logically, ready to go. And that really brings us full circle to the core takeaway. Professional trading isn't about having a crystal ball. It's a relentless cycle. You analyze, you execute, you review the results, good and bad, and you adapt your plan. Every single piece of data from today becomes a building block for making a smarter decision tomorrow. Which leaves us with one final thought to chew on. We've just dissected a single 24-hour period. But in markets that are moving at the speed of light, constantly driven by headlines and algorithms, how do you really know if you're executing a repeatable strategy or if you just got lucky on one particular day? That's the real puzzle, isn't it?